We are now completed with the 7 steps of the accounting process, and we are ready to move into selling of inventory, which is going to be a little bit more involved than just selling a service, say like a dentistry or mowing a yard. Now we're going to move into selling goods. And when we sell goods, first thing here on my notes is we're going to have at least 2 journal entries whenever we sell anything that is product-based. The first journal entry is going to be just like we've always done. We're going to record the sales revenue. So our debit is going to be either cash or accounts receivable, and our credit being sales revenue. And then the second entry, that's going to be the new thing that we're doing. We're going to have a new account. One of the new accounts is called cost of goods sold. And that is it's on our T account sheet, and we'll get into that when we get into the problem. That is an expense account. It's basically expensing out the inventory that we originally purchased. And it's expensing that inventory at the cost that we bought it, not the cost that we're selling it at. So therefore, the difference between what we bought it at and what we sold it for, that difference is our profit. And that's going to be called our gross profit. Because if we don't do this second entry, then it would make it appear in the accounting ledger that everything we earned was pure profit. Now, in a service business, it is. You're basically giving away knowledge or doing manual work that doesn't require any supplies or inventory, and therefore everything you make is pure profit. But when you are actually selling goods, that's not the case, because you bought that inventory. So if you bought it for 20 bucks and you sell it for 30, you didn't make 30 bucks as your profit. You only really made 10. And so that's what we're going to see here. So here's just a real basic explanation of what we're going to be getting into. So the first thing you have to have before you can even sell goods is you have to buy your goods. And when you are buying in stuff that you're going to resell, we call that inventory. So the first thing we do is we show our inventory on our books, and our inventory is an asset account, just like supplies would be before we use them. And then remember, just like how in our adjusting entries, when we use supplies, we expense it out. When we sell the inventory, we expense it out. But instead of calling it inventory expense, we call it the cost of goods sold. Just break that down, and it tells you exactly what it is: the cost of the items, the goods that we sold. All right, so we bought 150 items for 10 bucks each. We turn around and sell now quite a few of those, 100 of them, for 30 bucks each, so we're making a profit. So our entry, if we sell 30 for 30 bucks each, 100 of them, we are bringing in $3,000. So that's our first entry. We already know how to do this, or should know how to do it. What did we get? We got cash. Why did we get the cash? Because we did our job. We made a sale. The second part is the new part, where we show that those items, we go back up here and we remember that, yes, they cost me 10 bucks each. And if I sold 100 of them, 100 times 10 is 1,000. So my cost of goods sold would be 1,000. That's how much I'm getting rid of my inventory. And then I credit my inventory for that 1,000. So that if I was looking at a T account, I had 1,500 and I just took away 1,000. So I still have 500 left of inventory. So the final little step here, we didn't really make 3,000 in profit. We really made 2,000 when you take the 3 minus the expense of that inventory. So we had profit here, what's called a gross profit of $2,000. Well, that's one of our new terms, cost of goods sold. A few other terms that we're going to get into when we look at our practice problem. We're going to have whenever you sell something, there's a chance that your customer is going to return the item. And we've all done this. We've taken an item back. Either we didn't need it or it was defective. And so we have an account, and we have this in our T accounts as well that you'll see. We have a sales return. This one, like accumulated depreciation and like our dividends, this is a contra account. And it's a contra revenue because it falls in the revenue section. It's the opposite of a sale. It's our sale coming back to us. So therefore our sale is nulled out. We didn't really make a sale on that item. When we have a sales return, the sales return account is only for the seller. The buyer won't show a sales return. They do it a little differently because you can't have a sales return if you never had a sale. And so if you're the buyer, you never had a sale. You bought merchandise or you bought equipment, and then you're just turning around and giving it back. And we're going to see how it looks from both standpoints in our problem. But this is one of our new terms that you need to be aware of, our sales return as a contra revenue. Okay, another couple items we're going to have is discounts. We give a discount, or we can receive a discount if we make a payment early. And it just depends on what it's called, on who you are. If you're the buyer, we call it a purchase discount. Now, my note here is there's no separate T account called a purchase discount. It's just known as a purchase discount, and how you actually account for that in the accounting problem is it reduces the cost of whatever you purchased. And so you probably purchased one of two things. You probably purchased inventory that you're going to get a discount on because you paid it off early, or you bought a large piece of equipment and then you're paying it off early. So that's why I put reduce the cost of the asset, because it could be more than one item. So we're going to credit whatever it is we bought. So if we bought something and it cost us $100, but when we made the payment, we only had to pay $95 because they gave us a discount, we would show that if maybe say it was inventory, we would credit the inventory for that $5. Therefore, our inventory was originally at 100 debited, but we just took it down 5. So now our net final cost of the inventory is what it should be, $95. If you're the seller, you record this as another contra revenue account. Again, it's the opposite of a sale. You're actually losing a little bit of money than what you thought you were going to bring in. So back to our example, if I thought I sold stuff for $100, and so I counted it as revenue of 100, but I let them only pay me 95 by urging them to pay me quickly. And so therefore I take that $5 off as a contra revenue and call that a sales discount. And then our last new terms here, we're going to look at shipping, because shipping is definitely involved when you make a sale or if you're buying something, and we're going to see how we account for that. There are two different types of shipping that we will that you can possibly have. It's either the buyer is paying for it or the seller is paying for it. And when it's called FOB shipping point, think of this as free. FOB stands for free on board, but I like to change it up so that it actually stands for free to the buyer. And I think that'll help you maybe remember who's going to get the free, or they actually have to pay the cost. And so it actually stands for free on board. But think of it as free to the buyer. It's free to the buyer only until it gets to the shipping point. So it's free only until it gets to UPS or the post office or the UPS. Therefore, it's only free until it gets to there. So the buyer is having to pay for it to be from UPS all the way to their house. So when it's FOB shipping point, that means it's the buyer's responsibility. The seller may have to pay for it up front, but then they're going to charge the customer. They're going to charge the customer that extra price. Now, when they charge that extra price, they don't count that as part of sales revenue, because they're not making extra money. They're just reimbursing themselves. So when we do this, when it's an FOB shipping point, you might think, oh, well, then it's an expense to the buyer. Well, it's definitely not an expense to the shipper, but you'll see in just a second, it's not an expense to the buyer either. When it's the shipper, we don't call it a shipping expense because they may be paying it up front, but they're ultimately not paying it. The buyer is paying it by reimbursement. So what we do is the seller may pay it, and they may credit their cash, but their debit is going to be an account payable to UPS, not a shipping expense. Or if they do, let me take a step back here. This entry is going to be part of the sale entry. I like to do it like that. Sometimes the book will do it a little differently. It'll do it separate. I like to do it as part of the actual entry. So when we debit the account receivable for the client, for our buyer, we're going to not only debit that $100 that we sold it for, but we're going to also debit $10 of the shipping. So we're going to have an AR debit for 110, and then a credit for sales revenue for 100, and then a credit for either cash or AP UPS if I haven't paid them yet, the extra $10. That $10 isn't my revenue. So the key thing here with FOB shipping point, the buyer ultimately pays. Nobody has a shipping expense, as you'll see, because you think, well, what about the buyer? Didn't the buyer call that a shipping expense? And you'll see that no, we're going to get to that in just a few minutes. The buyer actually adds that to the cost of their equipment or inventory or whatever it is they bought. So when they bought the item for $100, they actually paid $110 to get it to the store. So that is what it really cost them. $110 needs to be debited to that item that they purchased, whether it be inventory, equipment, or supplies. When it's FOB destination, that means think of it as free to the buyer all the way until it gets to their place of business. It's free all the way until it gets to the destination. Free to the buyer. Think of it, that's how to think of it. Instead of it saying free on board, think of it as free to the buyer all the way until it gets to their destination. Therefore, the seller is the one paying the shipper, and the seller has to bear that cost, no reimbursement. And this is the only one where we're going to have a shipping expense, is when the seller pays and they don't get reimbursed. Okay, one little thing, just because they're going to throw around these terms now. We need to know the difference between a perpetual and a periodic inventory system and our sales system. When a business uses a perpetual inventory system, they're keeping track of everything they buy and sell the second they buy and sell it. They're always making a journal entry after every single purchase or sale. That's perpetual. You're doing it all the time. So you know exactly how much you have within a little bit of reason to how much inventory or sales you have. Whereas the periodic method, and so this perpetual method, this is very easy to do if you have computer and you have scanners and they're constantly updating, not a problem. But if you don't have all that fancy equipment and you're doing some of this by hand, using Excel, or you don't have the automated version like a Walmart or Target does, where it's just scanning barcodes, you're probably going to be forced to use the periodic method. The periodic method, you don't update your inventory after every single sale or after every single purchase necessarily. You update it at the end of the day or the end of the week, depending on how many sales you do. So the periodic, you're basically, and this is what we're gonna do a little example of this here in a few minutes. You're gonna add up in a little separate ledger, how much inventory did you buy? How much did you start with? How much extra little costs came in the way, like shipping, or did you have any returns? And then you're gonna count up how much do you have left after all of that. And then that's gonna be able to tell you, after you've counted up everything you have left, how much you actually sold. So we're going to see that equation in just a few minutes. So just remember that perpetual, you're always updating. It's always doing a journal entry after every single sale. The periodic, you're doing one big entry at the end of every day, perhaps, after you've counted up to see how much you have left of inventory. Okay, so when I said that the buyer, when it's FOB shipping point, therefore it's free to the buyer only until it gets to the shipping point, that they don't have a shipping expense for the buyer, that's because of this rule in accounting, that any costs that get the item to your store ready to use or sell it, if it's inventory, any cost that gets it ready is included in the base cost. So obviously the sticker price, what you bought it for. But then if you had to pay sales tax, that gets included into the bare bones price. If you had to pay shipping, so shipping coming in, that gets included. But notice it's only shipping coming in. If you turn around and sell the equipment, then that doesn't get part of the shipping, the inventory price. That's different. Getting it ready. If you have to install your piece of equipment that you're buying, that gets included. There's not a separate expense for the installation. And then if you happen to return something or you get a discount on something, that takes away from the price of the asset that you just bought. So just to kind of give you a little breakdown of what the formula looks like. So we have our beginning inventory, whatever we ended at with the end of the last day or the last week. How much do we have to start out with? Plus, on a little side, we're going to jot down how much we bought. So that includes any other cost that gets the item ready to use. That includes shipping, installation. And then we're going to take away any returns. If we had to return something that we didn't need or was broken, that goes away. If we got a discount, that goes away. And then that's going to tell us, once I add up how much I had plus what I bought minus what I gave back, that's going to tell me how much do I have ready to sell. And then when I go through and at the end of the day or the end of the week and I count up how much do I still have left. So let's say I had $200 ready to sell and I only have $50 left. So 200 minus the 50 tells me I sold $150 worth. It's pretty easy to get cost of goods sold, and this would be the periodic method because I'm updating it once a day instead of every single transaction when it may not be realistic to do that. So I gave us a little example here. I ask you how do the following affect the inventory balance? So is the inventory going to go up or down? Look at it. You might want to get out a little T account. I made a T account down below when we go through this one to help explain it. So not only how does it affect, how do each of these items affect inventory, but then finally, what is my cost of goods sold? And use the little equation just up above and see if you can solve that. So I want you to take the next 2 minutes, 2-3 minutes, pause the video because I'm going to go through the answer here in just a few seconds. But take the time and see what you get. Let's see how close you are. That's the best way to learn this is if you actually try it, and then if you did error, because if you don't do it and you're constantly just going along with me, you're not going to learn it as well. That's just how it usually works. All right, so go ahead and pause at this time and see how you do. All right, so for our answer, what I've done is I made a little T account here on the Word. It's not as nice as on an Excel sheet perhaps, but you can get the picture. So inventory is an asset account, plus minus. It said we started with $2,100 worth of goods on the plus side. Okay, then we got to think, what do we do with purchases? How do purchases affect our inventory? Well, they make our inventory go up. We're adding more stuff to it. That just makes sense. Then we have, says we had to return a little bit of our purchases. $350 worth. How does that affect? Well, that return is going to reduce the cost of my asset. I just went through and listed all my debits first. So the only other debit that I had when I look at these is the cost of that shipping coming in. So the cost of the shipping, that gets included in my inventory cost. Notice I don't call that a shipping expense. I don't call that anything else other than it increased the price of my inventory. That's it. So that's checked off. I had $350 in returns. That's inventory I don't have anymore, so I need to take it away. I had $150 in a discount. This would be a purchase discount that I received. So they gave me $150 off the price. That's basically all I'm doing is taking $150 off of this, the $4,500. So I just take $150 off here. I don't call it a purchase discount. I just simply credit my inventory. So all of these, I would just be debiting inventory, debiting inventory, debiting inventory, crediting inventory for these last two. So when I add up everything I have, when I add up everything here and subtract out these items, this is part of my equation, what I actually have ready to sell, the cost of it. So $6,300 worth. And then at the end of the day or the end of the week, when I went and counted everything up, I had $1,700 worth. And how do I get that? Well, all I need to do is if I had, let's say I had 100 items, these $6,300 worth was 100 separate little individual items. And so I just divide this by 100 and I say, oh, that's $63 a piece. So then at the end of the day or the week, I added up all of the items that I had, and if it was 10 items or 20 items or whatever it was, then I would multiply that by the $63 a piece. And that's how I would come up with this number, the $1,700. So then the final question is, how much did I actually sell? I know what I had available to sell, and I know what I still have after I made some sales. The key then is, how much did I actually sell? So I just do the difference here. 6,300 minus the 1,700 is my cost of goods sold. Because the best way to really get this material is by actually doing it. A lot of this stuff we're going to be using, and I'll probably revert back to it. And I wanted to introduce you to it. How the final thing to see is then how does all of this come together when we're doing the financial statement. So remember, everything builds on in this class. So we've done an income statement so far, where we had revenues minus our expenses gives us our net income. Now we're just expanding that. So our updated income statement, what it looks like, we still have our revenue. It's always our top. And we keep that out here in our total area. But now we're going to take away some of the new things that we got from our revenue, because remember, they're contra accounts. So we take our revenue and subtract out any discounts we gave, and subtract out any returns that our customers brought back to us. So remember, this is our sales returns. We are the seller and our customers brought it back to us. So if we had $100 and we gave a $5 discount and then maybe $10 in returns, we really only made a net sale of $85. We didn't really make $100 in sales. So that's our next term, is our net sales, what we actually sold, not what we listed originally. This is what we originally listed, and that's good to have, but our prime number here that we really need is our net sales. And then we subtract out how much did that inventory cost us to purchase and to sell. So we take our net sales minus our cost of goods sold, and that gives us what's called our gross profit. What did we actually earn by selling? So we had $85 in my little example, and let's say it costs us $50 to purchase this stuff. So 85 minus 50, that leaves us with a $35 profit. And that's before we can even put in all the other expenses that I had to run a business. Because people have got to know about you, so you've got to advertise. That takes money away. Then you got to pay rent. You got to pay the electric bill. You've got to pay maybe your workers' money. So you have all these other expenses. Add them all up, take it away from your 35, and you're not left with very much most of the time when you are a business that sells inventory. And then simply you take your income, and then if you're a corporation, you take that income times your tax expense. Maybe it's 20% for a corporation. So let's say you're down to $10. $2 goes to income tax, 20%. Your final income is only $8 when it's all said and done. Out of that $100 initial revenue, you ended up only earning $8 on your bottom line.